Thanks for coming. After you've made all your investments through us, you start thinking about an exit, and we have a great panel here to discuss and give us some guidance on exits. Glad to welcome Brad Raymond, Global Head of Investment Banking at Stifel. Steve Glanz, currently at Convizit, and he's a three-timer. He's had 2 exits through M&A and 1 IPO. Marta Plana, thank you. Welcome. Great to have you here. She's a board member of SC Barcelona and a director of the club's Innovation Center. Mark Selinger, welcome. He's actually opening up the Israeli office for McDermott, so welcome. We look forward to working with you. And Noam Kaiser, who works with Intel as part of Intel Capital, focusing on the Israeli market. So we have great panelists here, and hopefully we'll have a pretty open discussion about what should happen. Who should be leading? First question I'll ask you, actually, Brad. Who should be leading the effort at the company as far as financing and getting the company ready to be sold?
I think that who should take the lead in preparing and pushing an exit, it depends entirely on the situation and the company and the experience of the people involved. We've had situations where it's been a board member, it's been the chairman of the board. That's more often the case when it's an earlier stage company with a less experienced management team. We have situations where it's the CEO and he or she is very much driving the situation. We've had other times where the CEO really may have been much more of a salesperson and the CFO handles things. So it really depends on the team that's in place. A big part of it, and when I'm talking about that, I'm talking a lot about the discussions and the strategy and thinking through how to organize and manage a process. Obviously, there's a lot of internal work that needs to go on, and I'm sure we'll talk about that and the preparation and being prepared. Typically, that would be the management team and out of the CFO's office.
Thank you. Mark, do you want to add a few words?
Sure. It's obviously a time-consuming process, and you need to be running a business at the same time as you're running whatever the exit process is. So, delegation is important, but I do think that whoever can probably best enunciate and represent the vision of the company is probably the right person to be in the driver's seat. But I think that I've seen far too many times a situation where it's a 3-month process, and at the end of the 3-month process, the management of the company has sort of slipped. So
shouldn't it be the CEO that's doing this? Or?
It depends how many hats the CEO wears. But yeah, often it is. I guess the one caveat I'd say is that sometimes, particularly when you've got an exit where the CEO or management team is continuing on, there's a bit of a not necessarily unity of interest between, say, the shareholders and management. So that's a time where you may want to have a board director or even sometimes a controlling shareholder have a seat at the table.
But going one step back, Martha, financing, you've had a lot of experience with it. What would you say companies need to do? Should they actively go and meet investors? Yeah.
So basically, is it working?
Oh, it's working. Okay. We have no confidence.
So basically, Barca Innovation Hub is a lab that fosters startups and knowledge, technology, and innovation. What we see is that exit needs to be on the roadmap, but it definitely helps a lot to actually draw on strategy when it comes to knowing what it is that they're going to do in the near future. But again, they have to drive also that technology and make it grow. So we definitely think that startups need to have that strategy on the roadmap, but they don't need to only foster into that knowledge for exit. So they need to still grow.
Steve, you've done multiple financings, exits. What's your take on it?
Yeah, I think it's always important to be thinking about those things. I think, first of all, maybe stepping back, it's important from the beginning to do things right with proper legal. I've run into lots of problems where early on we did things that weren't documented, and it causes major headaches. When our last company got acquired by Oracle, they went back to a consultant that we did one day of work for us and it wasn't properly documented, and they were worried he might have an IP claim. It was crazy. So even though everyone hates paying lawyers, no offense, but I think it's really important to do that. So to kind of have and always be thinking about that. You're going to have investors doing due diligence, eventually acquirers, and I think that at every inflection point at the company, which is usually around a major financing, it's important to think about, is the right move here to finance this company, or is it proper time to think about an exit? Because each time that you raise more money puts you in a very different place in terms of the potential exits, and I think it's important for companies to really keep that in mind at those major inflection points.
Excellent. Don't know how many entrepreneurs here, but a big question we often ask ourselves is how much runway should a company have? How much financing should they have? What's your take on that? Would you invest in a company that has 6 months after your investment, or what are you looking for?
By default, no. I think that the role of the CEO at the end of the day is to generate revenue. And if a CEO goes into, basically, I'm going to quote JFrog's CEO, Shlomi Ben Chaim. He has a great quote. He says, "Ever since I became a startup CEO, I sleep like a baby, wake up 4 times a night crying." But that is basically it, because you need to buy the CEO significant runway to allow him or her to act at least for a year, and then take into account that they're going to need 6 months for the next financing round or liquidation event. So that means that by default, we would not invest in a company if we're not giving it at least 18 months of runway, preferably 24. Less than that means that the CEO will have about half a year to work, even less, and we've done nothing.
And would you invest in a company on your own, or would you look for other partners to be there?
We prefer to invest with other partners. Actually, even Intel Capital, just to explain, is a corporate VC that is mostly financial in its approach. We are measured on ROI, basically. But we have decided that as a goal, we want to broaden the amount of other strategic investors that we co-invest with. But we do also invest with financials, usually taking the lead position.
Steve, do you want to add on that?
Remind me what the question was again?
It's how much runway a company should have. So
okay, absolutely. Right. So, you definitely, I've been in different positions when it comes to financing. And the worst thing is when you have to start thinking about the next round, literally the day you close this round. And that's just awful. I think it's also not smart for investors to put companies in that situation. And you always want to make sure, again, hopefully you've raised a decent amount of money. When you're thinking about going out to talk to new investors or acquirers, you always want to make sure that you have the leverage in that situation. And if you're running up against a cash crunch, things really change. And those processes always take longer than you think. So I would say always start raising money before you think you need it, and while you still have a significant comfort zone.
Great. Taking advantage of Brad being global head of investment banking, what stage do you want to see a company that is A, looking for a financing, and secondly, thinking about an exit?
I think it's hard to really execute effectively for a company if you haven't worked with them. It generally takes about a year, so it's 6 months to process the transaction, and then 6 months to get to know them and make sure you understand how they work and what their needs are and how to position them, and they start to get to know you. So it's probably a 12-month process. That said, that's on the short end. We've had situations where we've been calling on companies for better part of a decade before we actually execute a financing or an M&A for them. And that just depends on the situation and the dynamics that are involved. The most important thing, though, is that you get comfortable with the advisor that you're selecting, and sometimes that can be relatively short. Sometimes you may want to take some time and get to know a couple of or a handful of advisors so you can pick. People have different skills. Firms have different strengths. They have different relationships. They can do different things better. So you should spend some time getting to know them, and that also will allow them to get to know you. That said, you can spend all day, every day with an investment banker, and that's not a good use of time either. So you need to walk that fine line. But I do find that when there's sort of a shotgun relationship and you're getting called, you're baking off, nobody really knows the management team. They select a banker and they get go to execute on a transaction without having some form of courting process and not getting to know each other. That's when I find when things don't work as well. So there's a fine balance between getting to know bankers and bankers getting to know the company and not wasting a whole lot of time.
Do you want to add something, Martha?
Yes, I would say that for us, for example, in the hub, we have approximately 80 startups right now. And what we do is we want them to be concentrated in co-developing those products, and then we'll take care for them to partnership with investors and to look for financial sources. But it's definitely really important that the team concentrates not only with the revenue as a CEO, but co-developing those products. So I think it's kind of like the other way around as a hub, and then again as a co-founder for other companies, the way we see it. It's
But
the
isn't it
other
much more
change.
fun for the CEOs to be told how great they are meeting bankers? Right?
Probably it is.
Yeah. Okay.
You can waste a lot of time with bankers, for sure.
Another question is, and sort of it's, another question is, again, are companies sold or are they acquired? I mean, that's, what's your take on that?
Well, the answer is both. The best situation is you get bought and you have the buyer at least thinking that it's all their idea and that you don't really want to sell and you don't need to sell because you have plenty of capital. That's the optimal situation. And we spend a lot of time as advisors, both formally and informally, trying to set up situations that dynamic happens without the buyer necessarily knowing that they're being set up. So we'll help companies penetrate big tech buyers or big corporations, and so they can set up commercial relationships without us saying the company's for sale, and then all of a sudden it becomes the big company's idea that we really need this technology or we really need that company. That's the way to maximize multiple, maximize price. So that's the ideal. Doesn't always happen that way. And so there are a lot of times when companies are sold. And we sold a business to Oracle, well, I'm dating myself a little bit here, 8 to 9 years ago now, and Oracle didn't want the business. It took us 2 years of pushing hard on Oracle, both the company and us, at the board level at Oracle, to really make the case Oracle was by far the best buyer. And we sold that business for about 6 times revenue. So it was a good outcome, not a great outcome, but we clearly pushed. The other situation where companies are sold is into the private equity world, and that is especially in tech, in software in particular. Private equity has become an extraordinarily aggressive buyer, as many of you know, and often the preferred buyer because there's more flexibility. And it's very rare that you aren't selling a business to private equity, even if a private equity firm comes to you as a CEO or a board member and says, we want to preempt and we want to drive, we'll pay a really good price. It's very rare that you won't go out and run some form of process, because through that process you can also often find that outlier buyer in private equity that might pay that extra turn of multiple. And so those situations you're selling aggressively, and we've advanced so much over the last 10 years in terms of the maturity, and I'm talking mostly about tech now, that buyers, especially private equity buyers, are very comfortable with an investment banker selling a business and aggressively selling a business. That wasn't the case so much 10 years ago.
Noam, would you like to add on that?
What he said. But basically, I think that the situation, or the classic situation as far as the company is concerned, is, and this is a very Israeli tactics, but it applies to anyone, the best situation is when you make the buyer think it was his idea. And you have to look at it, let's talk about it from a multinational corporate perspective. The head of the business unit that makes a decision, we need to buy company X, always has 3 options. 1, we can invest further in our business unit and get this done on our own. We can start a new business unit that's going to do this, and you have to give me a really good reason why I shouldn't choose these 2 alternatives and go for the third one, which is buying that company. The way to do that, I think, has to do with a very deep and intimate knowledge between the leadership of that company and the specific business unit it wants to affect. When you manage to, at the end of the day, it's all about people. It's all about relationship, and it's about the knowledge they share. And if you are able to work your way into that business unit, understand their roadmap, where it is that they're headed, and what are the gaps that they have in order to get there, and how big are these gaps, not just technology-wise, but time-wise, you create that sense of urgency.
Isn't that NIH to some extent, what you're talking about? Or?
But that is exactly the balance. That is exactly the balance. It can go either way. And as far as you're concerned, you're delivering the message that that's where you're headed. And let them decide, hint, that will be a better decision.
We have a lot of startups. Shouldn't they be concerned, sort of coming to a big strategic like you, opening up the kimono, sharing their technology, roadmap?
I mean, absolutely not, because if those startups, again, first of all, in order to show that you're interesting, you don't need to tell us everything. You don't need to open up your entire IP portfolio in front of us. It's enough that you show us the impact that you've already managed to create for some of your customers. And yes, it's very impressive for us to see that you know what we're doing and have an opinion about it, which again, something very Israeli to do. If you're able to do that, you will plant that seed of doubt, which is basically what you want to do at the beginning level. And then it's really about building the relationship. Eventually, that can lead either way, either to cooperation or...
Another question, I think... Okay,
Just
sorry,
one last thing. I think, and even if it doesn't lead to a sale, it can lead to some commercial relationships. Absolutely. It can be extraordinarily effective. And I think that's the Trojan horse. I do see companies wasting a lot of time trying to get sold. And to Marta's point, they should be you really should be driving revenue. You spend too much time planning your IPO or your sale, you'll get distracted and you won't have the sales, and then nothing really matters. The one area where I think you can mutually benefit the company is by trying to build those partnerships. That should help you drive some revenue, and it will definitely help you when you're ultimately trying to sell the business, that those business unit leaders know your company, they understand the dynamics, they know that it's going to be very hard for them to build, and they ideally have socialized the idea of your company within their organization.
I know you mentioned, Martha, that you've got 80 companies and you don't think the CEOs should necessarily be doing all this activity, certainly running a process. Do you think they should be meeting potential buyers ahead of well, not even ahead of an exit, just as understanding the universe?
Well, the thing, if we go backwards, is should all of them be selling their companies? No. And should all of them be going IPOs, or should all of them be exiting? So if we start from scratch, what I believe is those CEOs need to have that point on their strategy in the roadmap, but not necessarily be working only for that. As we said, we need them to co-develop the product, and that's what's going to make them grow. So as a co-founder, I co-founded a company. It ended up selling the company to a big corporation. But again, those kind of startups that are at Football Club Barcelona now foster technology and knowledge that is helping athletes to improve their results within the field. And I think that's very gratifying, and they can't be thinking or selling the companies to others. We'll take care of that. We'll do that for them. We'll introduce people, and we'll partnership worldwide. And of course, again, the Football Club Barcelona, our slogan is we're more than a club. And again, we have a very big spectrum of fans and supporters, and you're giving them the possibility and the advantage on being on the hot spot of everything if they collaborate with us. So definitely the CEOs need to be very much concentrated within their teams to make sure that the performance of the outlets improves and work within our club. But we don't want them thinking of anything else so far.
No, and look, I think the global trend is such, certainly even in our portfolio, the companies are definitely extending their runway today. They're not looking to be sold because there's a lot of capital in the market, and that capital is even giving partial exits to the entrepreneurs so that they are able to take some money off of the table. That's a definite trend, but when we do finally get towards the exit, that's the money time, and the question is if you should be ready and how much preparation you should do ahead of that.
Actually, we've now co-founded a VC fund in the US, and Football Club Barcelona is part of that VC fund without investing on them. There are other companies, but what we try is to track all startups, and those startups give them the alternative of being able to have a contact and a partnership with investors so that they don't actually have to go and roadshow by themselves. We're doing it for them.
Mark, what's your take on it?
I was thinking about a specific experience we had with a young CEO of a technology company, a handwriting recognition software company, and he told me that he was afraid to talk to potential buyers, but those potential buyers were, and these are strategics, were also his customers. So he said when he started talking to the folks on the M&A and business development side of these companies, and these were large international companies, he said he got a very different perspective than when he was talking to the product people, because the product people need to get what they need to do their business, and when he was talking to the M&A group, he said, he got a better perspective on how they view the company from a more global perspective, and how, from a positioning perspective, what the company needed to look like. And he said it actually affected how he was approaching R&D and thinking about R&D and roadmap and things like that. So I think there's value in that. Again, there's only so many things you can do in a day or in a week, but getting a perspective on what it's going to ultimately take to exit, I think, is valuable, and I think you get that by having those conversations with the people who are actually doing it.
So, Brad, when do you think someone should hire an investment bank?
Stifel? Right now.
Of course.
Again, it is very situational specific. I think that you want to hire a bank with enough time so they get to know you and you get to know them, and generally that's a couple of months before you're really getting into things in a material way. One of the mistakes we find is companies who go and start a process because they think they can do it on their own, or their shareholders think they can do it on their own, and it's a time-consuming process. You talked a little bit about this. It's often the perspective that you have as an entrepreneur or a management team is very narrow, and an advisor can bring a much broader perspective and help you navigate that situation. And so I would err, and I'm clearly biased here, on retaining an advisor sooner rather than later. It's extraordinarily hard to get retained as a banker and come in midway through a process and try to put the pieces back together. And I bet you, 20% of the situations we work on, that's how it starts down the path. So I'd be very deliberate about thinking about retaining an advisor. I'd get to know a few before you actually have to. You get yourself put in a situation that you need to retain an advisor. And if you're not going to retain an advisor, I'd be very confident that you can get whatever the situation is, whether you're raising capital or selling a business, I'd be very confident that you have that nailed. Now, there's a lot of capital sloshing around right now, and you may not need an advisor to do a $20 million top-up round for sure, but I'd be very, very confident in that situation. And Steve, you might have a perspective on that, just given the fact that you've been through it and hired advisors.
Yeah. So we did hire a banker when we sold our company to Oracle. I think what's really critical is that to recognize that once you've gone down that path and hired a banker, you've gone down that path, right? It's pretty much no turning back, because it consumes you, consumes your time, and
it's
so
out there. Everyone knows that you did it.
Right, and so
Basically.
like in our case, I think we had been working with Oracle. Oracle is our biggest customer. They knew us. It was quite clear that they wanted to buy us, but they're not in a rush. And we were going to have to raise more money, and we felt that the time was right. So we brought in a banker basically to accelerate the process, bring a competitive offer, and kind of make Oracle move, which worked. But I think if you're hiring a banker just because you want to see what's out there, that's probably not a good idea. You should be pretty certain that the time is right for you to sell. Otherwise, again, I think you'll just end up wasting a lot of time.
I would agree with that completely. I think the timeline can be relatively long. You could say, I want to sell over the course of 12 months, and some of what the banker could work with you on is laying out the landscape and making sure that you are connected into the right parties. But so that period can be longer than just 6 months. But if you don't want to hire a bank just to have them hang around and because they're nice people and you might want to sell the business. I would be committed to doing something before you hire the bank. I agree with that completely.
No?
Just to explain, this doesn't happen in a vacuum. This is not going to be the first time the CEO is going to meet a banker. Basically, bankers, as Brad said, they understand, they know what's out there. They're not waiting to be approached. Somewhere when the company raises Series C, it begins to appear on the radar. People are beginning to talk about it. Okay, this must be a next unicorn, baby unicorn. It's getting out there. The relationship will begin, and one of the ways for the banks to stand out is to show, look, we have an understanding of this field. Here's what we're seeing. Sharing that information, I think that's the right thing to do. What I can say, I think Brad touched on that, if you're the CEO or a board member of a company that carried out the acquisition and did it without a banker, by default, you have not optimized the result. And so and this is the reason why I think sometimes it's the board that sells the company, not necessarily the CEO, or definitely not the CEO on his or her own.
Steve, did you think that banks needed to have a local person, or was the management team happy to go and to fly to New York or London to meet them?
Yeah, I don't think having a local person would have really mattered at all. We worked with a bank where the partner, the partner who was focused on Israel was here a couple times a year. But all the buyers are out there. I was out there all the time. I didn't feel like I was missing something by not having someone in Tel Aviv. Not at all.
Mark, we've spoken a lot about investment banks. What about law firms? When do you hire a global law firm, and is an Israeli firm able to do what you do? What's the difference?
Sure. We like to get involved as early as possible. You get to know the company better. One of the reasons we're opening an office is to try to get those early touches, even if it's a small project, a regulatory project, for instance, where we just have or an employment issue, where we have the opportunity to just work with the company, get a feel for them, they get a feel for us. I think that creating that initial connectivity early on is very beneficial. We're working on an IPO for a client that's been going on for 2 years from when we started working with them and prepping. And the client said to me recently that he likes that when I talk about the deal, I refer to the company as we. And I think you get to that stage when you really get to know the company. You feel comfortable with them, they feel comfortable with you. As far as the question of Israeli firms, I've been doing this for 25, almost 26 years now, working with Israeli companies, and my most important referral sources are the Israeli law firms. And I have a huge amount of respect for them. I mean, it's one of the dirty little secrets that this is a very easy place to do business as a lawyer, because the people I work with, my colleagues at the Israeli firms, are extremely well trained and experienced. So we strike the balance, and we know what they do, they know what we do. I very much avoid stepping on toes because, like I said, I want that next referral from them. And it goes both ways. And I think when you have that level of communication and history, you kind of know where that balance is. You don't need to really talk about it much. You kind of know who's doing what.
Marta, sort of going off of your experience selling a company, and unfortunately some of the 80 will get sold eventually. What do you think, what do you find that the acquirers are looking during this due diligence process? What red flags should companies be aware of? You heard from Steve, a consulting agreement from a couple of years ago which wasn't terminated properly. What are the red flags you would warn the audience about?
I'm sure there are plenty of red flags. That's why there are due diligences, and that's why you go through a lot of points before financing a company or even selling it or going IPO. So basically, what we see is that you need to plan a strategy. You need to have lawyers. You need to have investors within your company. But again, what we do to foster a sports company right now is trying to attract entrepreneurs. So basically, what you feel is that those entrepreneurs, they want the guidance. So if you can guide them and foster that technology and innovation, an entrepreneur most times wants to be able to program and co-develop products. And I know I'm very, very tiring with this, but I very much believe that this is at least why we foster startups and 80 startups right now. So if you try to accompany those companies, they'll eventually find their way out, but those red flags are not part of their strategy. And as Football Club Barcelona, we're the first club to ever foster 80 startups within the technology and innovation to improve the performance and the athletes and to become the Silicon Valley of the sports center. So for the first time ever, you have companies that do not have to worry about that because we'll take care for them with the investors and lawyers and everything else. So for me, the biggest red flag is for entrepreneurs to focus on the business. And if they get sold, which they will, good for everybody, but at least they'll be able to attract the product and accompany whatever it is that they do to make it better for athletes.
Noam, excellent, thank you. Noam, your parent has been a very acquisitive in Israel. I mean, you spent 15.3 billion acquiring
Right.
Mobileye. It was rumored maybe you were looking at Mellanox. You recently
Was it
spent
now?
rumored. You recently acquired Habana. You know, what's Intel looking for in each of these companies, and another reason why you're so active here in Israel?
30,000 feet view. Intel aims to make everything based on data. That's the Intel mission. We think that everything works better with data. We think that even the things, we think that the grocery market works better with data. Basically, everything can be better with data, and that's where we're aiming. That's a lot of moving parts. And many of them, I'll answer beginning with the end, unsurprisingly, there is a pedigree here in Israel based on data collection and analysis for other purposes that has created a very wide array of talent that goes in different directions.
You're talking about our intelligence units.
I'm talking about 8200, 81, Mossad, absolutely. They retire quickly and start companies. So yeah, but it's not only that. This is a country that very early on has realized that it's not going to be able to rely on its oil reserves, so it's going to have to invent. Semiconductors and communications have been around here from the early 70s, and by default, a lot of the talent there is. We've just realized that in 2019, the three biggest investors in semiconductors were the United States, China, Israel. We're no longer surprised by that, let's put it this way. So what we're looking for is the way to, in a not very wide array, I would basically say in autonomous and mobility, which is area, basically we're looking at cars and vehicles and planes as computerized devices, IoT, artificial intelligence, big data, next generation devices. In each and every one of those, when we look for, okay, what are we doing correctly now? What are we missing? As we all know, Intel is pretty traumatized by the devices that you all have in your pockets and we're not part of. And we're constantly trying to think, what is going to happen not now, according to what our business unit thinks, but what is happening right now that is going to be evident in 5 years and we're not there? Those are the companies that we want to invest in. Subsequently, those are the companies that we would buy.
Brad, you know, company has had an inquiry, it's negotiated a deal, doesn't necessarily close. Is that the end of the company, or can they, is it a kiss of death for the company, or have you seen them continue?
No, it is, and I think this has shifted a little bit, but it happens more often than you would think, that a company will go down a process. They may not get all the way to, close to the finish line, but, for whatever reason, especially when you're talking about a strategic acquirer, there are a whole host of reasons that a deal doesn't happen. Some of which could be execution on the seller's part. Some of them could be having to do with the mindset of the acquirer. So it happens. The hardest part is that it becomes an extraordinarily large distraction for the management team, both in terms of time and also mindset. They may be thinking about how nice it's going to be to have some extra money in their pocket and take their kids to school and take a 6-month vacation. And then when that doesn't happen, it can be hard to get things going. But no, it does happen. And in a lot of ways, I think you, as a seller, you need to have a contingency plan, because You never know what can happen. Now, if you're running a private equity process, the certainty to close is a lot higher. But in Steve's case, with trying to push Oracle to a sale, that's hard to do. We've done it as well. So when you're doing something like that, you have to continue to run the business and have that mindset. One thing that I have seen companies do is the tighter you can keep the information flow while still being able to pass diligence, the better off you are. Because when you start getting it well known around the company that you're going to sell the business and then it doesn't happen, you got a lot of people that have gotten distracted and concerned. But it does happen, and companies fight through it.
Great. Martha, are there any pitfalls as far as, would you allow one of your companies to sign over distribution rights to a country, or are you concerned that later might prevent someone else coming in, and if a strategic does come along, they're blocked from
What you're
gaining
asking
access?
me, if we're going to allow, to sell the rights in
No,
another
I'm
country?
saying as you sort of oversee these companies, is it a concern of yours at all? Do you think of it at all, that, distribution rights to one strategic
that's
versus
very-
another?
No, absolutely. That's very complicated. We have a whole team of lawyers that analyze this on an everyday basis, and the roadmap needs to be very clear, because at the end of the day, you're talking about a club that's definitely very well known and number one in many fields. But what we're trying to do is to become the benchmark of innovation, technology, and research, and through companies flying over to other countries, we're making it happen. So, for example, there's a lot of Israeli companies that are collaborating with us, and we have one of them right here, Pixlr. And I think that helps us understand better what it is that technology does in this country, and then again translate it into our club and the other way around. So strategy-wise, there always needs to be very clear legal roadmaps, but going international, it's definitely a must for all of them and for ourselves too. At the end of the day, collaboration and an open, innovative way and culture of being the Silicon Valley of sports, it's what it demands society.
It's a competitive situation you have in Spain. Would you allow some of these companies to work with your competitors, or do you want exclusive?
Absolutely. I know there's a competitor there, right there. He's trying to hide himself, but I've seen you. But definitely, I think it's our culture, and we've always said that, is the Silicon Valley of the sports, meaning that we believe in transparency, in collaboration, and an open, innovative way to understand companies and to make them grow. Why? Because we believe that is the only way for our current society to be able to develop products and to be part of our club and our culture. At Football Club Barcelona, we say always that we're more than a club, and that's because we want to share all our knowledge and foster not only technology, but make them bigger. The only way to do that is by sharing what we learn, because the more you're criticized, the better you're going to be. So it's about it's about being competitive, right? And collaborating at the same time. So there's a new term in the UK that they're mentioning now by saying competition. So we want to be a competition and a benchmark in the field of sports and technology. Collaboration, but also competitive. So
They
answering
coexist?
yes. Absolutely. That's how companies and startups end up growing and being part of the whole field. Incumbents, new entrances. So you need to make it work. You need to make a regulation properly for all of them to actually be very happy and play the same game. So yes, competitors are welcome, and we've been the first ones to launch this innovative hub almost 3 years ago, and now there are a lot of other clubs that are following, so we're very happy to have them learning
So as
from
long
us.
as you sort of keep your 24-month advantage over the competitors, that's good.
Yes, but we want them to learn from us, and we want you guys to, exchange ideas. So definitely, yes.
Great.
If I can just compliment just one thing
Sure,
that Marta
sure.
said. You have to think beyond a single deal, beyond a single company. If we become an investor or an incubator or a hub, that paints its portfolio in its own colors, no one will come. You have to be very aware of the fact that, yeah, we invest in a company that's going to be bought by AMD or a company that's going to serve NVIDIA. That's absolutely okay. Otherwise, no one would come.
But CVCs do go through periods of alignment with the business units, and then secondly, as you opened up, you're actually measured on your financial returns.
Can we close the camera so I can answer? If you invest solely on what your business unit, and you mentioned that before about product, not necessarily knowing what the company needs to do. If you invest only on behalf of what your business units see for the next month, you will invest in poor companies. So there has to be a mix. You can't completely detach yourself from the strategic because then you don't have added value. But yes, you actually have to open up.
Great. Happy to open up for questions if anyone has them. We've got a great panel here. Any questions? Yeah.
From talking with VCs in the past, I've heard that if you talk about an option for an exit later on, that's something that puts off VCs because it shows that you're open to closing the company basically before you brought it to maturity or before what the VC sees for the company 10 years down the line. What would be your take on that?
Whether it's a mistake to talk about the exit when you're raising money from a VC. Look, we'll invest in you because you know how you're going to turn this company within 5 to 7 years to a company with $100 million run rate. You know why? That's why you're going to get acquired. It's okay for you to know what the crowd of potential acquirers is. Absolutely. We want to know what the happy ending is. Know it, but that's not your mission. What you want to say, yeah, we think that we make a lot of sense for these companies to collaborate with, maybe to be acquired, but the story is how am I going to build a company?
You know what? I in my own experience, when they ask you that, is it, are you going to be enough committed to the company, or is your goal, your only goal, to exit? So my recommendation as a co-founder, as a previous co-founder, is not to mention it, to know that you want to grow, that you're committed, and that whenever you're ready and investors know that, you'll exit, but not earlier.
Yeah, I'll just add. I mean, the VC business, as I understand it, right, is really based on having the economics are require them to have a few really, really large exits, right? And so, I think in every deal they invest in, they want to know that that's possible, and that's what you're selling to them, and that's what you should sell to them, and you should believe that, and you should be committed to that. That said, there may come a time where your interest and the VC's interest diverge, and then you need to make a decision, along with them, right? There's no point going on. Like in my last company, for example, it was very clear to me that we were going to run into problems with privacy legislation that was coming. And that was correct, and it would have been terrible if we kept going. So, you'll need to make those decisions along the way, but I think the economics of VC, they have to believe that you can become, a billion-dollar company.
Great. Do we have time? Okay, great. Yes, Robbie.
Something that you said earlier about the way your innovation hub is run, that you nurture the companies, you take over the financing side, you help them when they need more money, and you assist them when they're going to exit. As a minority shareholder in a startup, how can you convince an entrepreneur or a founder that now is not the time to exit, that they should be holding on for longer to be able to get to a much higher valuation at the time of the eventual exit?
Okay, just to clarify, we don't invest in startup companies, but definitely I think it's a matter of co-developing their product in terms of us having them in our lab and doing research and innovating and making them part of the club is what keeps us on the right track to be able to actually delay a little bit that exit. If you see that your company is growing as an entrepreneur, you want to enjoy that time, you want to be able to be part of that team, and you are happy that you're testing your innovative products within the first football club, right? So basically what we're trying to do is not to convince them, but to make them realize that they're living a very natural and very real part of their story, because it's only going to be theirs. And after that, we partnership with bigger companies, and we help them translate those efforts into financial needs. But I don't think it's about convincing, which it is too, because I see your point, but it's more of making them realize that that is a chapter that's going to make them grow and have better results at the end of the day.
And just to add 2 points on that. I think it's very difficult to dissuade a CEO that wants to sell his company as investors. However, one thing we do invest at OurCrowd a lot in is second-time entrepreneurs, because if you've sold your company for the first time, whatever the outcome, and you're now setting up your second, I can guarantee you, A, you've got financial stability. Secondly, aspirationally, most of those CEOs, those are the ones that want to create the unicorns, the multi-billion-dollar corporations. They'll meet banks, they'll meet financiers on the way, but they want to create the biggest and best in the category. And that's why certainly, and even those who've failed, by the way, coming back for a second time are also great candidates to invest in. Okay? Thank you very much, everybody. Appreciate your time. Thank you.